Ladies and gentlemen, let's take it to our next presentation. We have been waiting for this for a while. Financial crime considerations for fintechs, head of financial crime for EMEA, which is the EMEA, and the UK money laundering reporting officer for Stripe. Please welcome Mr. Aamir Hanif.
Okay, so I was asked to present on how financial services firms work with fintechs and how the challenges are between the two entities. But what's happened today is I've heard a lot of really good comments made by compliance officers, by CEOs. So I thought what I would do is I would talk about the presentation that I have already made, but put it in the context of what you have heard already, because all of you know how financial crime works and what the risks are. So all right, so these are the 4 questions, right? And you can read the 4 questions. They're on the screen. You don't need me to read the questions over to you. So the question is, what are the challenges that financial crime challenges that fintechs face? How do they overcome those challenges? How can we work with traditional financial services firms to mitigate those challenges? And how all of us can work with regulators to mitigate those challenges. So what are the challenges that face fintechs? They're the same challenges that face Habib Bank, that face UBL, that face Bank Al-Falah. The only difference is, how do you mitigate the challenge? So one of the things that one of the CEOs talked about was the time of onboarding, right? They said it takes longer to onboard someone in a traditional financial services firm than it does in a fintech. So if I told you that if you went on to Revolut, which is a massive fintech in the UK, and you wanted to open a bank account with them, you could open that bank account in 10 minutes without talking to anyone. And through that bank account, you could do cross-border transactions, send money over to wherever you want with no transfer fees. The question is, how do you do that, right? And that's where the fintech advantage comes in. So you type in your name, address, date of birth. That information is sent to an online database. That database checks and sees whether that information is valid. You get a link. You click the link, open up a screen, show your picture with your driver's license. You're verified face-to-face. You verified the identity, and your account is ready to go. Now, why don't traditional financial services firms do that? The reason why they don't do that, and traditional financial folks can disagree with me on this, is because of the structures that are already in place in those firms, right? So anytime you add new technology, it comes on top of old technology and makes things more complicated than they were previously. So that's the advantage that a fintech brings, is the technology doesn't exist. The old technology doesn't exist. And these are technology firms. These aren't financial services firms. That is why it is really important for financial technology firms to work with traditional financial firms to fight financial crime. So how do we work together? What I like to call it, it's called private partnerships. Essentially, banks own the rails. Banks own the processing rails. Fintechs own the client relationships. Banks will tell a fintech, these are the risks you need to mitigate. This is the information you need to collect on your customer, the KYC. These are the CDDs you need to do. This is the risk assessment you need to do. This is the customer risk rating model you need to make. Fine. If I told you that I have a banking partner, that banking partner says, these are the prohibited list of countries, these are the prohibited list of businesses, this is the prohibited list of transactions, you need to collect that information and assign high risk ratings to those individuals so that they get enhanced due diligence. Anyone who opens an account with me will immediately get a low risk rating, unless they have one of those prohibited factors, right? So a majority of the people will get low risk ratings, which means that within 5 minutes, they can start transacting. My customer risk rating model dynamically assesses their transactional behavior every 30 minutes. So I know every 30 minutes what your transactional profile looks like. If your transactional profile does not match your merchant category code, your behavior, I will change your risk rating to standard or high. So a bank can trust me because I have the technology database ready to tell them why a customer is low risk and is transacting, why a customer is standard risk, and why a customer is high risk. And a comment was made earlier that we should be partners with business, right? And that is partnership with business. Business will do faster business if I do work that way, which means they have more incentive to pull out the bad guys and come to me and say, that's a bad person because you're letting all the good people transact fast. And the traditional financial firms can learn from what I have put together. I have a presentation at Citi on Wednesday, right after I leave Karachi in London, to tell them about these things, because we can work together to fight financial crime. Now, what I haven't talked about, and I'm going very fast, so I have 4 minutes left, and I'm staying on schedule, is regulators. All of us have the same regulatory framework, whether you're a traditional financial services firm, whether you're a fintech. I have to satisfy the same questions from the regulator that a Habib Bank, a Bank Al-Falah, a UBL, a Standard Chartered, a Citi, BNP Paribas has to. So how do I convince the regulator that my technology-based model is as effective taking a risk-based approach to fighting financial crime as that of the traditional bank? I do it with the bank. I convince the bank, I show the bank that my system works, then both of us go to the European Commission, go to the Financial Conduct Authority, go to the Central Bank of Ireland, go to the Malaysian regulator, and we sit down and we say, don't worry about what you're writing, worry about what you want to do. You want to mitigate money mules, you want to mitigate account takeovers. This is how you go about doing that in the real world. In fact, I'll just give you one example, since I'm going ahead of schedule. I had a meeting with the European Commission where we were talking about 135, and people in compliance know it's, if you're an EDD, you do an update every 1 year, standard is 3 years, low risk is 5 years. There's a new AML law coming out in Europe, and the conversation was about that new AML law, and what we told them was, scrap the 135. Because it does not matter if you do the verification in 1 year, 3 year, 5 years. It matters if your risk rating reflects the risk of the customer, and if you are able to provide updated information on that customer at any point in time through geolocation tracking, through ongoing monitoring of the transactions, through consistent screening. 135 is old school. Well, 135 is like rules-based transaction monitoring, right? Because it's not behavior-based transaction monitoring. And so the opportunity here is for fintechs and traditional financial firms to work together, go to the regulator, encourage them to make rules-based, risk-based regulations that can be implemented across the board that help both fight the fight against financial crime and help business grow at the same time. And I have finished ahead of schedule, sir. So since I have a minute, if there are any questions, I'm happy to take them. And if there's no questions, I think I get the award for the fastest presentation.
Yours is a tough time record to break. You still had the timer running, and even the memento presentation happened within time, ladies and gentlemen. Round of applause for that.